Hi, I'm Jeppe Kirk Bond. I'm one of the most copied popular investors on eToro with 8,000 copiers and 150,000 followers, and I manage about 10 million US dollars. I often get questions about what new copiers can expect next week or next month in terms of returns. In general, even with decent diversification across geographies, industries, and business models, stock market investors have to be comfortable with a high level of fluctuations. Stocks do not provide a stable daily or monthly return, but can go up and down quite significantly. For instance, dropping or increasing by 10% in any given month, or doubling or halving in price and value in any given year. Over a horizon of many years or decades, it is, however, most likely that the ups and downs will average out to a strong long-term return. And for that reason, the best category of diversification is time. I don't think it's wise to get your hands up and jump with excitement because you made 5% return last week, and neither should you feel sad or disappointed if you lost 5%. You also should not switch between being excited or worried about your stocks based on whether it went up or down a bit. Instead, you should have a consistent level of care to assess the risks and expected returns. Historically, stocks and stock-like investments from before the first stock exchanges were invented have yielded 7% real return per year on average. That's equivalent to doubling the value of an investment every decade. So that means after 2 decades, you have 4 times the initial investment. After 3 decades, you have 8 times. After 4 decades, 16 times more. And after 5 decades, maybe your children might inherit 32 times the original real value. That means if a young person saves and invests just 1 year's salary today, never takes it out or spends it, it essentially means that a child of his might never have to work a day in their life. Or it can just be some extra cash at retirement or to spend on something else. I have personally yielded 29% per year on average with my investments, and 29% per year means more than doubling every 3 years. Available data shows for Warren Buffett and Terry Smith that they've respectively delivered 21% and 17% real return per year on average over various time periods. And so overall, that provides some guidance on what one can reasonably expect from the best investors. When you think about tomorrow, next week, or next month, the risks can seem to outweigh the potential returns, and thus people tend to hoard cash or invest in low-yield bonds, earning a safe 1% return per year or even negative after inflation. After a long lifetime, that might approximately mean they've doubled their original investment. I don't know whether it will end up with 16 or 32 or 60 times more for me, but I'm quite confident it'll be more than just doubling, as losing 10% here and gaining 12% there overall over a long time period averages out. If you become comfortable with ups and downs and think in years and decades instead of days and weeks, you'll be comfortable to invest more, and probably many years later, you'll be very happy that you decided to be a long-term investor.